Oh, good afternoon. It is sometime the week before the election. Actually, today is Tuesday, so we are a week away, but you may not be getting this until the next couple days or so. Um, Obviously, I'm Dan Murphy, and then Connor Briggs is with us as well. We're gonna, talk a little bit about kind of what to expect next week, and leading up to the election, and more importantly, beyond it, as we kind of just go through some of the quick talking points. We're not going to get very deep into the woods here, but
Mhm.
we did kind of want to go through with a close election like this is. We definitely want to uh, be able to kind of give you some really good talking points, especially if the markets become somewhat volatile next week, depending on what could happen. So we'll get right into the materials as well.
Yeah, so we're going to touch on current economic picture, kind of where we are right now in terms of the overall economy, such as jobs growth, inflation, unemployment, and kind of how of a seesaw kind of year or a roller coaster year rather it's been with that data coming out and kind of what the Fed's next step would be. And then, of course, we're going to touch on the presidential election, which as of today is about a week away. I know early voting has started in some areas, so um, obviously a lot of important things. So we'll touch on all that.
Sounds good.
So some of this might be redundant. We have brought it up on a previous webinar, as well as if you've been in on a review recently, it is something that we've certainly talked about at length. But huge revision in the jobs reports numbers from March of 23 to March of 24. About 818 less jobs added than they originally forecasted. So a pretty significant revision, which it is the largest revision that we've seen since 2009, which is coming out of the global financial crisis. So a big revision, and they overestimated in a number of different areas. Um, but what it's more importantly is showing that we have had a slowdown for probably longer than we have originally anticipated. The Fed is so focused on inflation, but really we've seen a slowdown in the jobs market, but maybe not realized it until this revision came out. So it was pretty sizable. Like I said, the biggest one in a long time. So it is definitely something to note going forward.
Yeah, I mean, typically I'll add to that as well. I mean, 818,000 less jobs, compared to, a forecast of 3 million jobs being created. It's a 30% reduction. So that's a huge revision. You can see in this chart that we did have it happen once before during the pandemic. And so, but that was obviously a very difficult time, but this not so much so. So makes it a little suspect for us. We have been kind of pounding the table for a while that we just think that most jobs that were being created, if you look further into the detail, it was governmental jobs, and then healthcare was usually one and two, sometimes jockeying back and forth. So typically it does make you a little skeptical when you see a revision like this. But certainly it makes us look at the economy a little different as well for everyone. So the next slide kind of shows it a little bit better. You can see that most of the job revisions that occurred out of the 818,000 revised numbers was professional and business services. And we're seeing that on our end too. Um, where you're seeing a lot less small businesses, rely on borrowing money for capital. They don't have money just sitting around billions of dollars in the bank like your bigger firms do, like Apple and Google and Amazon. They're always sitting on tons of cash, billions of cash. So small businesses rely on borrowing that money and interest rates are high. So have a harder time doing that. So small businesses, any kind of professional business services. So we've seen that where you're seeing either cutbacks or freezes on hiring as well for the business, for the small business and business world in general. So That's key. You want to add anything, Connor?
No, and I think what it really does is it shows how these interest rate hikes have kind of impacted us, all of us, really, even the individuals, the consumers. We're impacted by higher rates, whether it is borrowing to buy a car, to buy a house.
Hmm.
Um, 30-year mortgage, we talk about it all the time. It's over 7% now. 3 years ago, you're talking about less than 3%. So it is pretty significant, and it impacts businesses as well, especially those smaller companies that are starting out, that need to borrow a lot of cash because they don't have it on hand. One positive thing here, unemployment has remained relatively low. It did tick over 4% a few months ago, came back down a little bit, maybe we're at about 4.1 right now. So this is an important metric for the Fed to take a look at, because they don't want to see this. If it stays stable at that 4% number, that's fine. And I think that's what they expected unemployment to tick up. But if it starts to get to a point where we're at now 5%, even 6%, that would be troublesome. And that's showing that we're going into a real slowdown, possibly even a recession. At this point, we don't really foresee a recession in the immediate future. But if unemployment continues to tick up like that, the Fed might be more dovish, and they're going to look to cut rates even at a quicker pace than they are right now.
Yeah. This is a pretty um surprising number for us too. I mean, this is basically going through bankruptcies, and bankruptcies this year are through the roof. I mean, they're up over 109%. Those are big numbers. And it just goes back to the chart we just showed you a few slides back, where when we're looking at the amount of job revisions in the small business world and business companies in general, down 357,000 jobs. This is a big reason why these companies are either going out of business, can't, or whether it's just, consumers are not supporting them, or it's too expensive for them to borrow money to be able to stay in business. There's a lot of that we kind of see in our local areas too. So it is really a staggering number to see, 284,000 jobs under Chapter 7. Chapter 11, basically, which is a reorg, is 8,700 jobs, or I'm sorry, 8,700 businesses. So it's a big number. It's certainly not good to see it. I mean, obviously, we all go through those periods of time, but you can see this all for the last 4 or 5 years, and we are at a number that's way beyond even 2020 during the pandemic, which you would have expected that. In this case, it's a lot different.
Yeah. And you can kind of see right in 2022, that's where it's up 109% from these last 2 years. 2022 was so low at that point. Interest rates for at least half that year were relatively low, but you can kind of see it coincides with when they started hiking these interest rates over these last 2 years, where Chapter 11 especially has more than doubled. So just goes to show that it impacts us all. Inflation impacts businesses, it impacts the consumer. At some point, there are things that you need, and there's things that you can kind of live without. So if prices are getting too high, you stop paying for that. So that's obviously going to impact the businesses as well. So just kind of to show different areas where we're kind of slowing down in the economy.
Yeah, and that brings us right into the next slide too. I mean, you look at delinquencies, which we typically look at with credit card delinquencies, student loans, mortgages, auto loans. You can see for the most part, all loans have kind of stayed where they are, but credit cards, which is that blue line there,
Mhm.
they're still at an all-time high and climbing. So it's a big number, well over $1 trillion of credit card debt now too, in the United States. And so, especially for the younger generation, because there's a lot more people, using those credit cards as their lifelines. We do everything with credit cards now with, uh, you know, food shopping, restaurants, all that stuff. And if you're not either having enough income coming in because either you've lost your job or at some point the credit lines dry up too. And now, these credit card delinquencies and the balances remaining so high in them over the years, that certainly, 4 or 5 years ago, if that was, the situation where credit cards were through the roof, that was one thing, but you've got credit card interest rates now at over 30%. And I'm not even talking about store credit cards, Sears, well, Sears is out of business, but Kohl's, I mean, all these other companies, you're talking about 35, 36%. So, I mean, if you paid the minimum payment on these things, you're never climbing out. So, I mean, the realization is when we see these, the amount of delinquencies for 90 plus days, and 90, that means you're 90 days behind. And so typically, if you look at that, the credit cards are just staggering. I mean, student loans are in pretty good shape. That's a little suspect though too. Um, and basically mortgages are fairly low, which they always should be. And even auto loans are somewhat, there's definitely a good percentage of them, but not a huge amount by any stretch of imagination. And the revolving credit lines are basically under control as well. But those credit cards, are typically saying something that not only are they big numbers, but it's also big numbers for younger people, older people. Yeah, and I'll put myself in that category. We don't use credit cards anymore. You don't need them anymore. So typically you get to a point in life where if you're retired, you're probably not using credit cards at all. So it's the younger population. And at some point it's going to break and they're going to have a difficult time kind of making those payments, getting out from underneath that. That means they're not going to be able to go out and get mortgages or go in a house. That bad news for parents where you got, let's say younger people still living at home because they can't afford to move out, even paying rents. Rents are through the roof here in the Hudson Valley and all over the country. So they're staggering.
Yeah. And the one thing I'll add on with the credit card as well, balances are near all-time highs. I mean, we're about 1.1, $1.2 trillion. It did tick down a little bit last month, but what's really staggering it's the balances have increased, but also so have the limits. It is very easy to get a limit increase on your credit card. A lot of banks are doing it right now. And so obviously there's maybe some room on that credit card, but your balances are still continuing to grow. And right now it's at 30%. Even if they continue to drop interest rates, even at a quick pace, the credit card interest rates are never going to be a favorable rate. You're still going to be paying, could be 14, 15%, but it's still going to be a high interest rate. So even once rates start to get cut, it's still going to be tough for people with large credit card balances to kind of get out of that. So that would be a worrisome for me.
Yeah, this next slide talks about inflation continuing to fall, which that's been a barometer for the Fed to drop rates. You can see that climb in 2022 when we had close to 10% inflation. And then it's come down to 6 or 7. And the Fed's metric was they wanted inflation to come down between 2 to 4% for them to be able to start lowering interest rates. So we're there now. And certainly just because we may not, go into a recession like Connor said, which I agree with as well, we're still going to have some type of a slowdown. We saw that in September. Fed came out and lowered interest rates. And so we'll talk about that a little bit more when the next few slides with presidential election stuff. But, for the most part, it's a good sign. It means that, that they can start to look at lowering rates, get people, back to either going out and trying to buy cars or homes or get their credit cards, paid down a little bit better. But again, a lot of that also has to do with the slides back there when we talked about jobs. So anything you want to add, Connor?
Yeah, and this was obviously the number one metric that the Fed was looking to get under control when they started to hike rates 2 years ago. Um, Very important. It's become less and less their main focus. I think at this point, I think they think that they have inflation under control, and now it's important to obviously keep the jobs numbers where they're at and keep the economy flowing, but. If you really strip out at right now, inflation's at about 2.4, so it's close to what their target is. If you strip out, rents and home, that that really brings it down. That has not come down like I think they would have liked or expected. Rents still remain elevated. No matter where you are, it's still expensive to rent, and obviously the home prices have kind of remained stable as well. So outside of that, you'll see a couple ticks up in groceries. Energy kind of fell, but overall, the Fed is, I think, pleased with kind of where inflation is at this point. All right, now we'll move into the presidential election portion of this webinar.
Yeah, I mean, it's typically, that's something that we always obviously go through every 4 years, and for Connor and I, if you've been fortunate enough to come in the last month or so, you've kind of gotten our first take on things, and always it's a question that we get on in every review, what's going to happen with the election. And typically, we can kind of show you here that, presidential election years are usually pretty good. Um, Positive market years. This year, very similar to that, other than 2008, obviously, which was a financial crisis. I mean, for the most part, you don't have too many years in there since the 1920s where the market did not do very well. It's usually a very good performer. I guess for us, most of the times when you see a lot of volatility that's withstanding after the election is over, it's usually because something has happened where the market was not suspecting it. And so 2016, the market was expecting Hillary Clinton to win the presidency, and when the next day she was not, the market temporarily did have a lot of fluctuation and volatility, which was kind of short-lived, but normally that's because the market starts to kind of make decisions based on who a winner might be instead of waiting for the results afterwards. And so but typically speaking, usually it's a pretty good election year the market wise from that standpoint, unless it's really, something that really changes dramatically like a 2016.
Yeah. Yeah, no. So, and usually pretty strong finishes to the year as well. Um, I've shown this before. This measures VIX, which measures your volatility in the market, and usually, you see a big tick up in that volatility right around election time. Usually about 30 days, 60 days before where that starts to spike. 16 to 20 is really an average VIX. So that means you get normal volatility. Anything below that, it's relatively stable, and anything above 20 is pretty volatile. So you'll see here it gets up to 25, 30 right around that election time. So we really have not seen a whole lot of volatility thus far. And really, in a normal election year, if you strip out 2008, which we know was a huge drops in October, a lot of volatility, it's much more stable than you would think. So yeah, we'll see probably something right around election day, maybe a little bit after as they kind of price in the new candidate. But for the most part, the stock market has kind of done its job. The bond market, on the other hand, we have seen volatility recently in the bond market. And that's just because even though they've cut interest rates, we've seen treasury yields start to rise. And that's just based off of kind of who they're pricing in at the candidate. Right now, they're kind of pricing in a Trump presidency, and the thought process is obviously with the tariffs he plans to impose, maybe even tax cuts. could potentially lead to higher inflation. So more so those 10, 20, 30-year treasury yields have gone up a little bit, not as much on the 1 or 2 year side. So, that's obviously something to monitor, but we think that once it kind of gets priced in and the election day is behind us, we think both candidates, they're going to cut interest rates. They have to. Um, so we think that's still going to be good for that fixed income market.
Yeah, I mean, Connor's right. Typically the Fed will stay on its path right now. Even whoever wins the presidency will be a new president, and so will not even take office until January. And the Fed, I think, will go back to in November, lowering rates. They lowered rates in September a half a point, and I don't think that there's anything you have to read into that. I mean, I think they typically do it then at that level because to do any kind of drops or increases in October, most Feds try and shy away from that. It seems like a political move. And so they will normally reserve it for after or before. In this case, they decided to do a half a point in September, not have to worry about it in October and how it would look. And then November, we think that there's a pretty good chance that they'll do maybe another 1/4% sometime in November as well. So, and then we would kind of go from there. So, it is simply a normal situation. And I agree 100% that no matter who gets in, the interest rates will drop maybe further with the Trump presidency, but you just don't know. But from an interest rate standpoint, based on what he said, Trump would obviously want to try and get interest rates a lot lower quicker. But that also has to be, looked at as far as the effects of inflation as well that could have a negative impact on the economy as well.
Right. So this is we get asked this question a lot. How will the stock market do if X, Y candidate kind of gets into office? And I think it's important to remember that, as long as you own good companies, you shouldn't have to worry too much about the president that is sitting in office. There might be short-term volatility based off of something that they put into place, but for the most part, as long as you own good things, they will do well. And for example, under the Trump presidency, best performing sector was tech. And he had a lot of talk about obviously tariffs, as well as breaking up these big tech giants. You would think that that would negatively impact the technology market, but it really didn't. It was the best performing under his presidency. And on the flip side, under Biden, obviously his move towards away from oil. Oil was the second best performing, and energy was the best performer under his presidency. So, obviously that a lot of that was, due to Russia invading Ukraine rather than anything that he put into place. So outside factors can obviously impact these things as well, but it's important to remember that, while the president is important and he could impact markets, long-term view, still, as long as you're investing in good companies, you should do pretty well.
Yeah. I mean, no doubt about it, as we kind of move to that next slide, we could actually have a lot of volatility depending on what the situation is. If it is a close election, it may not be decided on the day after when you wake up on next Wednesday. It could go on for, a lot longer, a little bit of time. Nobody knows, and we're not going to guess either. But stay tuned. There could be a lot of extra volatility as we kind of try to weed things out. It's a staggering amount of people that both sides have hired now in every state, or at least the swing states, that would be, representing those particular sides, Democrat and Republican, for for different challenges based on whatever side thinks that they want to legally challenge for voting as well. I think the key thing is, like this first point that we have here, get out and vote. It's probably the first time that I've ever early voted. I did it on Sunday, and I know that, some of our staff here tried to do it yesterday, and it's been robust. I mean, obviously, in 2020, when we had our last presidential election, of course, that was during COVID. So, there were a lot of lines for that, but it's kind of good to see that people are getting out and voting now early, just in case, God forbid, something happens and you can't cast your vote on election day. Maybe it's a power outage. Maybe it's some kind of computer glitch that causes, people to wait for hours on end. Various reasons, but I think it is kind of good to be able to take advantage of that. So you've had early voting in a lot of states already. We started ours on Saturday. It'll end, I think, on Sunday. So you'll have a good, 8, 9 days to be able to go out and early vote. There are locations all over the local county, one pretty much in every town. And so, that's a great thing to do too. But expect volatility. We are expecting it, and we're ready for it. I mean, we have a situation kind of mapped out for each side. If Trump wins, if Kamala wins, we know exactly what we're doing on each side of it as well, and kind of what areas would be affected. With what Connor and I just said, I mean, basically the market sort of is pricing in a Trump presidency, but if he loses and Kamala's in, that would be something the market will not expect. And it will take maybe a little bit of time to readjust to companies that would do well with her presidency. So that's typically how it always works. With a close election, it's very difficult. Sometimes elections are runaways, and it's a little easier to kind of calculate that. But for close elections, a little bit more difficult, especially if the results are not correctly, calculated out in the end. So for us, we're ready, but we do feel that there's going to be more volatility than maybe in most years, as we kind of get past next Tuesday, and then we'll see how things shake out at that point.
Yeah. You got a feeling that it's probably not going to be over by next Tuesday. It'll drag out. And I think a lot of people would, want this behind them at this point. I think we're all kind of tired of talking about it. But like, obviously everything that Dan there said makes a lot of sense. So, if you have any questions, please feel free to reach out. Obviously, always here to have a conversation, whether it's about election or the markets. So, please don't hesitate to reach out and get out and vote.
Absolutely, that's a great idea. Definitely take advantage of that, and if you're not a person that goes out there very often and votes just the presidential election years, it's there, and it's certainly seems like a very uh close divided, election. So definitely get out there and vote, and try and get it in as early as you possibly can as well. So we look forward to hearing from you, from everybody, and enjoy the holidays. Hopefully we get through this okay, and then we'll see you on the other side next week.
All right. Take care, everyone.